Most investments carry risk, but there's one that is all upside. The only risk-free investment is an investment in yourself. The Globe and Mail is the largest business newsroom in Canada, interpreting and unpacking macroeconomics, housing, policy decisions, and world events. Enjoy a comprehensive suite of business newsletters, breaking news, and market updates straight to your inbox. As a subscriber to the Globe and Mail, you'll get access to investor tools like advanced charting, portfolio with the Wealth Scope report card, providing an independent 6-factor review of your portfolio, and stock screener to help you find the right investments. The Globe and Mail is offering a special digital subscription rate just for Loonie Hour listeners. For a limited time, get access for $75 a year for your first year. For more details, visit globeandmail.com/podcast.
Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 71. As always, joined by the three amigos. We got Keith Dicker of IceCap Asset Management and Rich Diaz of Acorn Macro Consulting. Welcome back to the show, gentlemen. Rich, what's going on, buddy? No flowers in the background today.
I know it's I threw them away because of and in my anti-Valentine's Day my anti-Valentine's Day act was to throw away the flowers. There you go. I also got a haircut, and in this country, all the barbers think that all the patrons want to be footballers. So now I feel like I have a European footballer soccer haircut, which I don't think I like very much. But other than that, all is well. All is well.
Bring the fro back.
It'll take a while. We'll get there.
Keith?
Rich, how is the Aussie accent? Can you do one?
No, I can't do an Aussie accent, sadly. But yeah,
so
good.
You know,
there's some great people from Australia. I've met some really lovely people recently from Australia.
I know, yeah. There's a ton known that way. So the funny thing over here on my side, this was Valentine's week, of course, and so which meant I went out for dinner with one of my school friends who was passing through town. So wow. Two of us are out for dinner at this restaurant. There's just couples everywhere. Like flowers are literally being delivered, and they're sharing desserts with one spoon and stuff. And it's my friend Glenn and I were just sitting down and just having a ball. And of course, which makes you ask, like, what about Mrs. Icecap? How did she feel about that? And she was thinking, hey, I should have been there too, right? You want to hang out with Glenn. But that's what happens when when you have this powerful connection for years on end. You don't need to have one night special.
When you're old, that's what happens when you're old.
Yeah. So you don't need to go seeking, this one special night or anything. It's always
all the
there.
days that you guys decided to go for dinner, you guys picked the 14th.
Yeah, well, he was actually flying through. We had a snowstorm here this week, so all the flights got pushed out. So he got laid over here in the city. So that's effectively what happened. But I had a real nice romantic dinner with Glenn.
Where'd you guys go? Red Robin, Applebee's, Kelsey's?
We like the Swiss Chalet. I like the quarter chicken dinner. You get the Toblerone bar at Christmas. Anyway, Steve, what about you? What do you got going on over there?
Not much. Just
love Lando.
Yeah, just heading to Los Cabos for a wedding on Saturday. So looking forward to that, getting out of here. But continue to watch with amazement of the housing market here. It continues to sort of snap back. So again, very, very odd. It's a very, very challenging market to get a real strong grasp on. I think it's much too early to draw these sort of conclusions, but it's crazy just to see, if you had a listing, you might get 30 groups through an open house now. Whereas, the same listing, you listed it 2, 3, 4 months ago, you might have had 5 groups through. So people are back. They're out there looking. They're seeing stuff going into multiple offers. Really strange. I'm surprised that people are actually even willing to compete. Given that mortgage rates are still in the 5s, they really haven't changed a whole lot. So, but we're going to jump into some of the national housing figures as we always get them mid-month here.
But Steve, I know what happened with the market. When you call the bottom there a few weeks back, like you're the market mover. Everyone said, "Oh wow, we better get in now, right?"
I wish I had that power, but I certainly do not. But yeah,
Steve is clipping 1% on every single national transaction now.
That's right.
Oh, that'd be pretty nice. But yeah, if you look at the so we were looking at the January statistics that came out from the Canadian Real Estate Association here. Keep in mind that last January was really, from a base effect perspective, January was almost the peak. So February, the market peaked out last February, but January was rip roaring. So the comps are obviously very difficult to beat. So if you look at your MLS home price index, your national house price index, it was down 12.6% on a year over year basis. That's the steepest decline on record, since the index was created. So the worst year-on-year change was March of 2009. So it had dropped 8.9% on a year-over-year basis. So we're now at 12.6. That February number, I can tell you, is going to look really ugly. So you could be looking at like year-over-year changes of about 15% in February. And it doesn't really matter if you use the home price index or if you're using the seasonally adjusted average sales price, which goes back to 1989, February 2022. So this is going to be the worst decline on record going back to 1989. So we are in the depths, or at least have been in the depths, of the Canadian housing bear market.
It's not much of a bear market. If you compare it to what happened in the US or in Ireland or in Spain or even in the UK in 2015 and 2016. Yeah. I mean, is that because of the crazy population growth numbers we have? Is it because so many of the households have already paid off lots of their debt? Or is it because maybe the listings, like we aren't getting the volume, and once you don't get the volume, the price discovery isn't as clear?
The volume for sure. You look at sales are running at like 10-year lows, right, across the country. Now adjust for population. That's pretty ugly, right? And new listings are kind of running in parallel to that. So yeah, to your point, like there's not a ton of turnover. It's pretty hard to ask the seller to reduce their price when the seller doesn't have any competition on the market. So and that's why I said, like, that's why you get 30 people at an open house, because everybody just shows up to the same one listing that got listed for that week. And so it ends up with 4 offers on the offer date. So yeah, really strange market, because like I said, given where interest rates are at, the levels of debt, you would expect maybe a little bit more pain, but I don't know. I know we're coming off this like insane, let's call it what it was, insane bubble in the housing market, blow off top of last year. But hey, we're down 15% nationally, and there's bigger markets in suburban Ontario, suburban BC that are off 25 to 30%.
Well, that's what I was going to say. Oh, sorry, go ahead.
Yeah,
go ahead.
It's only, I think it is a bear market if you've been exposed to this bear market. So if you bought something a year or 2 years ago, you're saying, oh man, this is really tough. Someone who's been a long time homeowner, they're probably aware of it, but you don't care too much about it. So like Steve said, it's people who are in the game right now. So you're in the game from either 2 years ago to today, or you want to get in the game. And like anecdotal stories and narratives and whatever you want to call it, like we're seeing a lot of people, like they're just waiting on the sideline. They got cash built up and they're waiting to buy. So maybe that low is in, that trough is in. But I keep going back though. All that so far has just been driven by rates. That's all it's been.
Yeah, good point.
If we get the recession that some of us have been talking about for a while, and it hasn't come yet, but if that happens, then you could really see a big thud come down.
Well, that's what Ron Butler said, right? That's what Ron Butler said, right? He said that employment are the 3 most important considerations when looking at sort of like the real sort of long-term viability of a housing market. Hopefully I didn't screw that up. But sorry,
We're
Steve,
gonna
go ahead.
we're gonna get into the job market too, because there was some data that came out. But just a quick recap on the last little bit on the housing front here. So if you guys want to quickly break it down by sort of larger metro areas, so home price index change on a year-over-year basis. So Canada again down 12.6%. Toronto leads the pack, down 14.2. Ottawa down 10.7. Vancouver down 6.6. Montreal 5.5. Edmonton down 3.6, and the sole outlier again continues to be Calgary, up 6.1. Bit surprised that market has been as resilient as it has been, but so that's where we're at. And then the next, I guess, shoe to drop is going to be what happens with the employment side. And so, we talked about it last week. The estimate was supposed to be, the economist consensus estimates were 15,000 for the month of January. And Keith, you had joked about on the show that said, watch the random number generator spit out, 10 times estimates. And that was actually right on the screws. We ended up with 150,000 jobs created in this country for the month of January. Of course, that sent yields higher. It removed markets pricing and rate cuts for 2023. So those have now been taken off the table. So I guess just your initial reaction, Keith, after the jobs numbers came out.
Well, there were two reactions to it. One was, holy smokes, like it was a blistering number. Because again, they have the estimate at 15,000 and it's 150,000. At first point, you're thinking, okay, maybe that there was an extra zero just added by mistake or something to that effect. But that was the number. Markets didn't know how to react initially. They weren't acting dovish. They were like, oh, wow. So then it comes back. It's funny. I think I was communicating with one of the big banks on the economic side. And, they get all the data but I didn't get the sense that they were they weren't sensitive to the estimate being so much lower than the actual number. And they weren't trying to defend one or the other. I don't think they cared too much, really. They'll just move on now to the next month because, there will be another big revision coming up to this 150 number. But, so there's two trains of thought with that number. One is that it's not a real number. It's weak somehow, and people are trying to find out why it is weak. And then the other side is saying, you know what, it's a strong economy. All jobs are not equal, but when you get the aggregate number increasing by so much, which is something that Rich has been spot on with, recently, maybe that's what's driving everything higher. I think most of the jobs from the services sector, I think, Rich, you'll share with us. But so it's coming back now to the Bank of Canada, which once again, they're in an awkward position. Can you ever think of a central banker being awkward? Have you ever seen that before?
Well, I mean, can I say my piece? They're going to raise rates again. So I beat you to it, Keith. I'm going to call it right now. That's the worst possible thing that could happen to Tiff is for him to take a victory lap, and then before he gets to the bench to squirt a bit of water into his mouth and clean off his visor, he is basically going to have to raise rates again. I think I'm going to call it right now. Whether it's because of inflation or what's going on in the US, we'll talk about that later.
When do you think that is, Rich?
Because of population growth.
No,
I think
when do you think?
Sorry, excuse me. Oh, I don't know. Definitely not March. I think that would make him look like too much of an idiot. But who knows? But I think before the summer for sure.
Because I'm literally scrolling through Twitter right now, and there's Kevin Carmichael. So he's like the BOC whisperer.
He's good. He's a good read.
Yeah, I mean he's obviously in cahoots, I think, with the BOC. But he literally just posted an article. It says, quote, the headline says, Tiff Macklem is sticking with rate hike pause despite blow jobs not report ... for now. So yeah, I think
that's right, because because one of the messages they gave us last time was that they feel, because remember it's hard, guys, right? You hike rates, it takes several quarters for it to start to bite. and they feel now that they've done enough, and they want to see how the economy will react to it. So I don't think they'll, if they swing that quickly, for 1 month, like Rick Rich suggested, that I that's gonna be very difficult for him to do. But you think he wears a visor? I wouldn't think so. Back in my days, we didn't even wear helmets.
Yeah, okay.
We just played,
nowadays
right?
visors are mandatory, even in the NHL. So that was where I was alluding to. But I think it's important to not to harp on this point, because I think we've called it spot on, and I guess it's a little bit boring to take our own victory lap. But when you have population growth of 2.25%, that basically means that that is what they're fighting. He's paddling upstream, to use another Canadian euphemism. I mean, he's paddling upstream, and until that number either moderates, whether it's through policy or whether it's through our economy doing badly and people not wanting to come here. I mean, that's happened before. I think someone shared a really cool chart with me about the mid 30s, when our population growth actually shrank to almost zero, because of the economy not doing well. I mean, it's just a situation where, this is why I think in hindsight, I think the calling it the victory lap was so dumb, because he's got this data too. You have this population growth smashing, just absolutely breaking records, and it's all through immigration, which is the other thing that I think is really interesting. So you literally just have more people chasing after a finite number of goods, which is, back to the housing situation, which is probably maybe put a floor under housing. But that the definition of inflation in first principles is a finite number of goods being chased after an increasing amount of money. And how do you generate that extra money to chase after those finite goods? Is you just increase your population significantly. And so that's why I think it's really kind of interesting that, given that background, that he was so kind of smug about it. But
so the percentage of the country who works, what is it, around 40%?
Sorry,
45%. What's the percentage of the population that is working?
Participation rates are low-ish. I think it's 65.
65.
No, but that's of people who can work. But the percentage of the population who can actually work, it's not
so
that
the employment
high,
ratio.
Because you got old people, you have students, and all that stuff. Do you know what I mean? So
I can't remember the employment ratio, but it's not that low. It's not 40. I'll have to check.
My point is that, though, if you have 2.5% population growth, I imagine the percentage of that 2.5 who are going to be working is quite higher than
very high. Immigrants have a much higher participation rate than
absolutely. So that would support the view or thinking that it is driving it up, but it's a very aggressive number, and we'll do it again next month. Maybe we should switch the Twinkie bet to the employment.
Oh my God.
Oh, that'd be great.
we'd be stacking on the pounds.
So years ago, when
it's pretty unpredictable.
When I was offshore for a while, our big bet every month was the non-farm payroll number to the US equivalent.
Yeah, we used to do that too.
Yeah, and the guy furthest away had to pay up to the guy who was the closest. And the comp was a pint at the anyone knows Bermuda was the hog penny. Which conveniently was literally about 25 paces away from our desk. That's how close it was. And but you're always accumulating all these pints. The funny thing was, we had several different investment teams there, and the bond guys who followed economics more than anybody, they were wrong the most. They were never
maybe they just like their beer.
What are you implying?
One guy did. One guy was very good. My other friend Scott from Winnipeg, who we heard of before, he intentionally would get it wrong, so then he'd have someone to hang out with.
Scott from Winnipeg is pretty famous after that Vancouver live event.
He was, yeah, he still is famous. Yeah. Okay, so we got the Canadian jobs data. Now we know that's the Bank of Canada.
Just to kind of summarize Rich's comments there on the immigration side. There was actually a report out this week from CIBC's Benjamin Tal. I mean, I don't think we certainly have our disagreements with a lot of the Canadian economists, but I think Benny Tal is really well respected, and I think he's pretty concise. So he put out a report basically saying, that the Canadian government's targeting 485,000, new permanent residents. And so, cities and municipalities and provinces are trying to build housing based on that number. But, he says, listen, like, we're not calculating all the foreign workers, all the temporary people that are here. And so he says that number hit about 850,000 people last year in 2022. And, he says by his calculations, I mean, that could hit 1 million people in 2023. And so that's, he argued that's what we should be basing our housing supply targets off of. So it's really interesting because when you really, factor in really what's been happening in the housing market, while there may be signs that we may be bottoming or we may not be, the reality is that developers have been curtailing new housing supply. It's obviously extremely difficult to get financing. It's a lot more expensive. We talked about one of the large developers here in Vancouver blowing up into smithereens, last week. And so, it's going to be interesting because I think we're setting ourselves up, if we continue down this course over the next 4 or 5 years, pulling in 1 million people a year, that and development slows, you're going to have a continued housing crisis. So it'll be interesting. But I mean, again, hopefully the federal government's listening to this and going to enact some sensible policy. They probably won't be, but
and maybe a lot of them might need a portfolio manager along the way. You never know, right?
I was told in no uncertain terms that somebody was going to solve the housing crisis. So I, for one, am quite disappointed that hasn't happened yet.
Which is quite interesting. Could you guys see the story floating around yesterday or today about our prime minister? So actually, Rich, from your side.
Oh, was it him? Was it him who said that? Oh, sorry, I didn't realize it was.
Yeah. But from your side of the pond,
of the aisle.
Yeah. So the gist of it is this guy who predicted or forecast that the Kiwi prime minister would resign. It did happen. And then was it yesterday that the Scottish
Nicola Sturgeon, the first minister of Scotland.
First minister, okay, she's gone. But in the article that came out today, it's in the Telegraph. It's an opinion. It's an editorial, of course. But he's specifically saying Trudeau is next. He's the next guy to get excused from his party. So maybe we'll have some political volatility coming up here in Canada, which could have an effect on this immigration flows coming into the country and other things. But that's something now that so again, that's news that's out there. Everyone will be tracking this closely. I'm sure he'll be asked the question. If he comes on the Loonie Hour, we'll certainly ask him that question. I know Steve will, but
all political colors are welcome on the podcast.
I mean, I can't speak to what's going to happen to Justin Trudeau's political career, but I can tell you, to just round the information out for our listeners, that the participation rate in Canada, which is sort of, like what is the participation rate? I screwed this up, which is like the labor force relative to the number of people actually employed, I think. Oh my goodness, I can't believe I cocked this up. This is a huge mistake on my part. But
Rich on a breakaway, and it just trickles off his stick. The visor, man, take off the visor, you'll see the puck better.
So the participation rate in Canada is 66% roughly, and the number of people employed relative to the total number of people is right now about 51%, and that's been flat since 2005. So we can share that chart.
Close to 40.
No, it's not. Anyways, those are the numbers.
Okay, so let's quickly then shift over to the Bank of Canada, because I think, Steve, you mentioned that there just recently was expectation that they'll be cutting rates towards the end of the year. So right now it's flat. Now those rate cuts are gone. Now we're flat forever.
You've got the Bloomberg terminal over there, sir, but
it's right there. I'm pointing at it.
The OIS, what was it? Were they pricing in 2 cuts for 2023? Now they're pricing in, I think they're pricing in 70% odds now of one hike this year now.
Right? No more hikes. We're done.
So they're still pricing no hikes. I guess.
Well, no, we could get 25 basis points maybe by
that's what I meant.
Yeah.
So there's a 50% chance we'll get a hike in April.
Okay.
45%.
But I mean, the reality is that, we're now dismissing the idea that we'll get a rate hike. So again, Keith, to your earlier point, right? I mean, you talked about, we've tried to going back and forth on the housing market here, and it's only the people that have really bought in the last, 18 months that are sort of feeling a bit of the pain. But hey, I mean, people stuck on these variable rate mortgages, it seems like there's not going to be any relief on that front for the foreseeable future. You could be dealing with high payments for another, who knows, 12 months. So when do you get your first rate cut from the BOC? Clearly the markets are pushing it out. And so I think it's just, these rate hikes are still going to bite. Record levels of household indebtedness hasn't necessarily
it just keeps coming back then to, the easiest way to measure the potential strength of your economy is aggregate spending. It's not what you can spend or what Steve can spend and stuff like that. It's on an aggregate basis. So on an aggregate basis, if people are allocating more of their discretionary income towards the mortgage payment, it means there's less money to spend elsewhere. So the only way for the economy to grow is by our government cutting taxes, which we're very confident they will or will not do. They're not cutting taxes, guys. That's not happening.
Yeah.
So therefore we need wage growth, increases and stuff like that. It's kind of interesting. I've been tracking a lot of the universities now across the country. Those with their labor agreements or the cycles are coming up, and it's interesting to see what they're agreeing to. So the wage hikes range between 1% to 2%. It's not enormous here. They're all asking for 4, 5, and 6, and that's clearly not happening. But we're not going to get enough wage increases, to offset that movement and with the impact of higher mortgage rates. Which means, of course, if the population is growing and more people are working, then it will help out that way. But I think, though, we keep coming back to what's happening with the economy here. And, we've said before that the risk with Canada is likely coming from outside of Canada, that's where it will emanate from. And so, we continue to hold that view. So, right now, if we're going to get a successful recovery, not only for the Canadian economy, but, for the Americans and Europeans, everywhere else, we're looking for, we want the Chinese recovery to be very strong. And right now, what initially started out as the hope was, this is going to be awesome. And Rich, hope is not a good strategy when it comes to markets. Or maybe for dating, it's a good strategy. I hope.
Oh man, that was a layup. That was a layup.
I know.
You can do better than that, Boomer.
When you don't have a visor on, you can see things more clearly. It's easy, right? Steve didn't wear a visor when you played.
I definitely wore a visor. I'm pretty soft.
He definitely wore. Look how handsome he is. He had to wear one. Right. That's why he's so.
Keith, were you a fighter? Little guy out there.
No, I was better than that. I was best friends with the biggest guy on the ice, so I didn't have to worry about those things. Yeah. He actually went on to play for the Canadian national rugby team, 4 World Cups. This guy's a rock star in the rugby world. And I just covered in his shadow. I didn't have to worry about those things. See, I was smart back then too. But back to the Chinese recovery, we need that to be sustained. And right now, there's a lot of funny things happening within China right now. A lot of them. So this blanket statement that they opened their economy, they're going to start growing again. You have to remember that the Chinese economy grew based on debt growth. There's no Chinese miracle, none of this Asian miracle. It's all driven by debt. And one thing the Chinese government are very focused on right now is ensuring that the housing bubble doesn't continue to get bigger and then break. So lending to the household or the housing sector is very low. The growth is almost negative at this point. So instead, corporations can borrow quite a bit, but they have a very sort of, like every economy, it's imbalanced. That's the way to look at it. But we need the Chinese economy to recovery to take hold, and then that will help with commodity prices as well, of course. We need to see the world have a de-escalation in geopolitics. So specifically, you want the war with Ukraine and Russia, you want that to slow down. And then also, this is Rich's favorite one. We need inflation data to come down to a reasonable number, that's acceptable. And so if we clear those three hurdles, then yeah, it's going to be awesome again.
Ski,
So
isn't
oh, sorry, go ahead.
Isn't the PBOC pumping liquidity through the system right now?
You beat me to
Well,
it.
they're really. I don't know if anyone noticed. Like over the last 3 weeks or so, or 4 weeks, the CNY, or it's Chinese currency, whatever you want to call it, CNY or CNH, depending on which one you're looking at, and Hong Kong dollar as well. They've both been depreciating during a period when the US dollar was depreciating as well around the world. So there's a lot of dollar outflows coming out of the combination of Hong Kong and China right now. So that's something you want to watch significantly. People know that story well enough. If you're following it, it may not happen. But if they were to relax either one of those pegs, because the Chinese currency has a bit of a soft peg, they don't tell anyone what it is, but they'll sort of massage it. But there is something foot over. They need foreign currency quite a bit. So we'll see. Maybe that's the kind of event that would spread elsewhere.
So what I wanted to add was that the PBOC is one of the only I'm pretty sure is the only major central bank. So the People's Bank of China is the only major central bank that has cut in the last, let's say, 12 or 24 months. Their stated goal is to provide ample liquidity. Money supply growth is 12+%, which is the highest it's been in a long, long time, maybe a couple of years now. Corporate bank lending, as Keith mentioned, is starting to rise after falling to, I want to look at right now, Jesus, almost 10-year lows at the beginning of 2022. You're seeing bank lending growth is starting to creep up. And interestingly, you're right, Steve, the central bank has basically started to accumulate assets. So what does that mean? It's starting to basically print money again. Although unlike in the West, where you have central bank assets as a percentage of GDP in the 30s and 40s and whatever it is, China did not print money in the same way as the rest of the Western central banks did over the past 8 years. So they have very, very little central bank assets as a percentage of GDP. That's, but what the point I wanted to make really though is what started as, Keith mentioned hopium not being a good strategy. The market is often succumbs to hopium. And when China did open up, all of the industrial metals and a bunch of tech stuff just lit up. And now you've seen an absolute reversal in a bunch of those things. So just to read off, all of the following metals have fallen more than 6% in the last 2 weeks. Cobalt, palladium, nickel, zinc, tin. So nickel, tin, and zinc are used in steel and all that kind of stuff. Steel rebar is down 3%. Silver is down 8%. Palladium, platinum, all that stuff is used in either in catalytic converters or high tech stuff. Then there's rhodium. Rhodium is the only metal that's up basically in the last 2 weeks, and that's a crazy move, right? So you had a huge rise because everybody's like, oh, it's on in China, and then it's sort of a collapse really just a couple weeks later. And then I would remind everybody that the PMI is my favorite, the diffusion index of both in China is 47, which is quite low. So it's not going to happen as quickly as I think the market sort of expected. And it'll be interesting to see how that plays out and reverberates to the rest of the world.
So what's the takeaway here? The reflation trade is hope.
I think it's different. I think you have to split it up. I think you have to split it up between Europe, US, and China. And China, I think the reflation trade is going to take way longer. I think the US, I've mentioned it over and over again, the US consumer is cashed up, unlevered, and if inflation and their houses are not a factor. And I think the spending from there, we're going to get into retail sales, maybe we should get into now, is going to continue to surprise people. And then Europe is the irrelevant guy sort of in the middle, where it's dealing with super high natural gas prices. Natural gas prices are 5-6x what they are in the US. And they're also a much more export-oriented economy. So they're much more dependent on what's going on in China. And so it's I think that those are sort of the three stages right now. So, but I think and that's why I continue to write in my notes, even though I've been wrong for the last month, that I don't buy the growth over versus value rotation. I think that the value and all those defensive plays still have a long way to go.
Heath?
If we are going to have this soft landing and a recovery, you're going to see this severely inverted yield curve start to correct itself. So it's either going to correct with overnight rates coming down, which that won't happen because there's a recovery taking place. So instead, you'll have the 10-year and the long bond start selling off, which acts as an automatic anchor back on the housing market up here.
So tighter financial conditions. Well,
I mean, you can have spreads can tighten, which is good. But if you all of a sudden you have the 5 and 10-year rate moving higher again, because we're not moving into a recession, I don't know. I'm not a buyer yet of this strong recovery story. I think there's just a lot of cash flows are moving around from oversold and overbought markets, and that's what's pushed things around here now and into the middle of February. But I also, though, I am concerned about geopolitics and how that might develop as we continue to move along here. And again, I keep going back to the situation with Ukraine, that you don't hear anybody that wants peace. So then by default, it means they want war. So which by default means, this something will happen here coming up. And if that happens, and that's the trigger point, which will create this, once again, this risk off move. But there's lots of things lined up here to have a very dramatic move. And, the whole idea that it's this, super strong recovery that the central banks did the 2-point landing, 10-point, what do they call it when you come off?
10-point landing.
Catch your toes? Is that what it is? 10 points?
I think it's because that's the most you can offer to a competitor when they're doing they spin off the pommel. What is it called? The pommel horse or something? I don't know.
I thought it was 6. I thought it was a factor of 6.
No, remember that lady from Montreal 1976 Olympics got 10 perfect score of 10, 10, 10? Nadia Comaneci, I think is her name.
Yeah. I think she was she wasn't Russian, she was Czech, I think, wasn't she?
I think she was Romanian.
Romanian, yeah.
Romanian.
Yeah, absolutely. See
what
what you're learning here on the Loonie Hour? Isn't it just incredible stuff that we go through? So, Rich wasn't even born back then, by the way, but that was the Sugar Ray Leonard Olympics, right? It was the 76 one in Montreal.
That's the only two things I know about the Montreal Olympics is that it took Montreal 30 years to pay for the damn Olympic Stadium, whose roof never opened, and Nadia Comaneci got a perfect 10. Those are the
that's all. Anyway, we should
know. That's right. That's all we need to know. We should move on. We should move on.
So,
but let's go back to her third event, the one that
Rich, you've been framing up. In your writings there, the inflation's going to be stickier than many people are expecting, and you've been saying that for a couple of weeks now, and obviously it seems like the market's actually recently come around to that view as well. We've seen this resurgence higher in bond yields, and we're seeing we had the recent data from the US CPI as well. I don't know if you want to walk us through some of that CPI. We also had PPI data, producers price index data in the US today. So I don't know if you want to quickly walk us through that, because I think it is more or less confirming what you've been calling anyways.
Well, I just think it's, I try very hard to predict the future, and I definitely got a few things wrong. I just think in general, the market got too aggressive on the inflation coming down to 2% thing. And I think that was reflected in the Fed funds rate hike expectations, which have now corrected, as you pointed out. That's happening in the bond market a little bit. We'll see. But anyway, the headline inflation didn't fall as much as expected. Remember, it's always about expectations versus reality. I know it's kind of technically and kind of annoying sometimes, but core fell by 0.4%. Headline, sorry, excuse me. The core rose by 0.4%. Headline rose by 0.5. I think quite a bit more was expected. And then so now we're at headline is at 6.3 in the US and 5.5. As always, just like the Canada, we always look at the components. So what fell the most out of the major components was used cars and trucks, and virtually all the other components rose month on month. Now that could be sort of a function of seasonality. You can't take the month on month stuff too seriously, but it's good to get you sort of just for a feel of what's going on. So energy services rose, energy commodities. So there's services and commodities. They split those up. Those rose by 3.4 and 2.7%. Things like food at home rose by nearly 1%. Services, which is the key, this is the lion's share of most people's consumption basket, rose by 0.8%. Month on month. Those big numbers. Again, as always, the thing that I keep on harping to, and I have done for now almost 3 years, is the shelter component does not seem to be slowing down yet. The shelter component rose again. I think it was 0.7%. Again, as we always talk about, it's 40 odd percent of the core basket, and now it's at 7.9%, and core is at 5.5. So until you get that shelter component, like it, hate it, whatever, you're not, the math doesn't square. You need to have, if it's 40% of your basket, that means you need the 60% that's not shelter to be significantly below that 2% number, or your math doesn't sort of add up, right? We're talking about weighted averages here. We're talking about sort of a target, and if you don't get those other components to play ball, it's not going to work out. And that's why things like used cars and trucks are so fascinating. We had a huge contribution in the middle of 2021, 22, and now that contribution has gone back down to zero. And my point that I will make is that your contribution won't be significant drag either. It'll just go back to its long-term average, which is basically zero, because it's such a small component. So we'll see. I mean, we saw the retail sales in the US do really, really well. Consumer confidence is starting to bottom out because inflation has stopped falling. I think that it's sort of a Main Street versus Wall Street thing that I think we're starting to really see play out, where you have the Main Street, which is strong employment growth, decent real wages. You have job shortages are still strong. The JOLTS thing, which I could never remember what the damn acronym is, that's really strong. Consumer confidence rebound, housing, I know people are on and on about that. I just don't think it's as big a deal. Whereas you have Main Street, which is under pressure from crappy earnings, margins are getting squeezed, industrial production is weakening. And as we said, we always say, the labor market is the lagging indicator. It'll be the last sort of penny to drop. But that's my wrap on the US. Keith, do you have anything to add on that?
Yeah, lots of things that you missed. So let's just reset here. So before this data came out this week, remember we had basically all the central banks, they went from being hawkish to either less hawkish, or they're pausing. They've done that pivot. So the Canadians did it, the Europeans did it.
UK,
the Brits do it as well? Ish, right? Yeah. And everyone thought, the Americans were going to do it as well. Remember, the U.S. Federal Reserve is the most important central bank on the planet, is the most important economy, the most important borrower, and all that stuff. Everything, it's a U.S. dollar world, and we're just living in it. And the expectation was that, the Fed were going to do maybe another quarter point, or maybe even a half a point, but you could see the vision out there that, they were also coming to that end. And, every now, you hear Powell speak, and it would drive me nuts. I don't know if I said it on our podcast.
Yeah, you mentioned it last week as well. Yeah.
Like, you listen to if you read his words, you're just thinking, man, he's hawkish. He's hawky as anything. But then you listen to him say those words, he's like, Barry Manilow singing hawkish. Right? It just doesn't have the same effect, right? But then the data, though, it's still was giving the Fed support or data to continue being hawkish, and that they will continue to raise rates. And there's another big personnel move, or HR move,
yeah, that's right,
that happened at the Fed this week. So Lael Brainerd, is that how you pronounce her surname?
Yeah,
Brainerd.
Brainerd. Okay. So she was basically, she was put onto the Fed as, to be Powell's, replacement effectively. And, and so I know there's a lot of infighting taking place at the Fed. You have the power struggle taking place. And then you also have the fighting taking place between the Fed and the Treasury, because the Treasury is aligned with the White House. It's a political appointment, and the Fed is supposed to be neutral and all that. But Brainerd now has just been recalled back to the White House. So I think she's now going to be the top economic advisor at the White House. So she's now been yanked out of the Fed. And because she's leaving or has already left, it means that there's now an opening seat, which is going to become a temporary holding until they get the new permanent one. Not the rotation seat coming in. And that is, it's Loretta Mester or Meister. I don't know her surname. I think she's with the Cleveland Fed. And when you come, now all of a sudden she becomes a voting member. And she is as hawkish as you can ever draw up. Yes, you in the front row.
Sorry to interrupt you, Keith, but you forgot to mention that Brainerd is a super dove.
Yes, yeah, it's a good point. Yeah, absolutely. Yeah. So now all of a sudden you had the dovish voice is now gone and is being replaced by a hawkish voice. Did I get that right? Yeah.
I think so, yes.
Yeah, so now it's, she was out on the airwaves this morning, doing all, kinds of stuff, but it's now setting up the opportunity for the Fed to continue to be hawkish, which means more rate hikes. The COT data, commitment of trader report, that shows who's short, whatever markets and stuff. There were a lot of people were short the dollar recently. That's why it was weakening the first part of January, because it was so strong last year, right? You just get that pendulum swinging back and forth. So the move has been set up here now for the dollar just to slingshot higher again. And it's going to be on the base that, the Fed will continue to raise rates more than what's expected. And, everyone else is sort of sitting still, on the rate side. And we'll sort of flip back to the whole Chinese, Hong Kong dilemma they have. Every time the Fed raises rates, it actually tightens the economy for both China and Hong Kong, because their monetary policy is pegged to the Fed because of the currency impact of it. So it's a very big move this week with that taking place. And I think right now we're sort of back in this middle of no man's land. We've gone from, we're definitely having this recession to, it's a soft landing. Now we're going to, slowly go back to, maybe it's worse. It's a soft landing, but with inflation still taking hold and employment not growing and all that stuff. I think it's become rather interesting, Steve.
Yeah, I think it is. I think I think it's a tough market to really square right now. It's like, what's the outcome going to be? And you can see everyone betting on where interest rates are going to be, like flip-flopping. It seems like on a weekly basis. I think the volatility in the bond market is really interesting. Rich, what's the I don't know if you have it handy in front of you, just the MOVE index, the bond market volatility index. That's got to be
excellent question. Something I talk about a lot. It fell. So it's an index. So it's really hard to make square what these dumb numbers mean, right? It was at 150. It was, for the last 4 years, it was at 60. So it's like, you can't quite say that the volatility doubled, but for the sake of this conversation, let's just say so. Volatility doubled, which was very, very high as interest rates all went up, and it came down as, the last, 4 months or so, it's been way down, but the last week has seen it start to creep back up again, which I think is kind of interesting. It obviously reflects higher bond yields. I don't know what's happening with spreads. We can ask Keith what's going on with there. What I think is really interesting is the VIX volatility index. There's a VDAX for the Euro stocks. There's, I think there's like a V topics or whatever. There's volatility indexes that are for all major index equity indexes. That just continues to be stapled down to, so it's at 18 now, which is, basically bang on its long-term average. And that to me is the one that I find. So you're right, Steve. I find interesting. You're right, Steve, to point out that the MOVE index is creeping higher after sort of coming down quite a bit. But it's that VIX volatility index that I find just sort of fascinating. It just won't go up. I don't know why.
Keith, what are your thoughts?
I have no other thoughts. I have a comment, observation. Nothing to do
Uh-oh.
with
Hit us with your
index.
wisdom.
I
Oh,
like
no.
I like everything. You know, I'm a well-rounded individual. I mean, I'm like that.
In your mansion.
Yeah, in my mansion. Dianne Feinstein. Feinstein? What's her name? Feinstein. She's announced she is not going to run for re-election again.
She's a senator, right?
Yeah. She was in the swamp for 30 years.
Amazing.
She went in poor. Her current estimated net worth is 200 million.
Man, how do we get into the swamp?
I know exactly how to get into the swamp. Somebody in America, God love those people, created an ETF that will track the trades, the machinations of the Congress. So that's both houses, senators and Congress, and upper house and lower house. And it's called NANC. So NANC. So this is not investment advice, but it's and that's basically for Nancy Pelosi, obviously, who is basically just amazing at front running all kinds of legislation with her trade book. I hope allegedly. So that's exactly how if you want to, instead of getting in the swamp, why don't you can, not investment advice, buy the ETF that tracks all of their trades. It's just genius. It's just, you gotta love it. You gotta hand it to these people who do that kind of stuff.
I just love this stuff. It's right in our faces, and yeah, you know, some folks lost some money. Who cares?
Yeah,
that's all we can do. Yeah.
I mean, I think she sold something like 3 million shares worth of Google like 4 or 5 days before they announced that they were going to sue Google for antitrust violations.
That's unreal.
It's a good one. Anyway, yeah, like everyone else,
Allegedly,
there, you know, working 2 or 3 jobs. And anyway, I just find this stuff, you know, fascinating. And we didn't talk about the UFO story this week. You know, UFOs are invading Canada.
Oh,
shooting down everything these days.
Oh, geez. Is that what we've descended to? There's lots of stuff.
I think what's more interesting is like, why am I reading this now? Like, you know what I mean? Like the idea of like, why is this becoming front page news story is more interesting. Like the narrative and the story is building around, you know, these geopolitical tensions, you know, so I think that's really the takeaway.
It's just
here.
It's distractions, right? I mean, that's what it is, and it's happening. And you know, I'd laugh at it, you know, with one of my friends on Twitter he's pretty sharp. Let's say, UFOs are in, and the F-16 shot it down. He's saying, guys, if you really think it was a UFO and they traveled all the way across the
yeah,
galaxy,
exactly. Thank you.
You think they might be able to avoid an F-16 like missile coming at them, but just sort of square the peg though. When there's a lot of that happening, because it picks up, the media are picking it up, like everyone's commenting on it, and even CNN went with the story that maybe it is UFO. So, children, if you're watching CNN, you might want to change the channel.
Turn it off.
But to be serious with this, and again, from our perspective, it's served as a distraction to something else that's happening out there. So it's not just a random event; it's happening at once. Remember that this is getting airplay for a reason, and maybe it's economic related, maybe it's another reason related. But don't be the least bit surprised if there are other things happening behind the scenes right now, and they come out now in the near future.
Okay.
You know, down the road.
Keith doesn't speak for me, but you know, I think that, you know, it's Occam's razor. What is it? The dumbest answer is usually the right one. I mean, it could just be that it's just what happens when you have 2 superpowers that are going to spend the next 50 years fighting each other tit for tat. It's spy versus spy out of the Mad magazine, and this is just the beginning of it. If you don't think America is spying on China with their, you know, bombers and et cetera, I can't believe we're going down this road.
US has got their own balloons flying over there.
Yeah, exactly. Thank you, Steve. That's my point. I mean, you know, I think what's amazing is that no one's talking about basically the worst environmental disaster in American history. I mean, talk about being distracted. I mean, what has happened, and there's an oil spill. I think it's in East Palestine, Ohio, I think, if I'm not mistaken.
You're gonna get the Loonie Hour kicked off the airwaves here.
I mean, it's just absolutely, it's really sad and quite amazing, given how much I think all this, I mean, these chemicals are used in our daily lives, and we need them, whether they're petrochemicals or acids or bases and all this other stuff. They should be handled with care. Obviously, these ones weren't. And I think basically an entire city has been wiped off entire town has been basically wiped off the map. It's really, really quite sad. So definitely look at that.
You won't find it anywhere, but you did hear it on the Loonie Hour.
No,
a lot of things.
I do not want to position the Loonie Hour in that direction, boys. Let's stick to economics. The Bank of Mexico raised rates more than expected.
I do have one piece here I think we should just quickly chat on. We'll wrap the show up here, but there was a good tweet from Ed Harrison. He used to be with Real Vision. I don't know who he's with now, but he wrote that financial conditions are loose enough that we may have to consider whether the interest income channel of monetary policy transmission has become dominant. So basically what he means by that is that, the interest that's being generated now on, let's say, savings is actually adding to stimulus to the economy.
It's a real good point. You guys may not know it, but Ed was one of the first guys to start a blog, basically. He did it back in the O. So it's called Credit Write-Downs. I don't know if he's still doing it or not.
Yeah, I don't know, but he's out there. He's quite a popular follow.
Yeah, he's a sharp guy. And so you think about, we had over a decade where, you call it, it's basically savers were bailing out investors. Okay, so we weren't getting paid anything on our cash balances. So the little old lady was basically bailing out, everyone else, so to speak. So we've had that for over a decade. And now all of a sudden, we're getting paid money on cash. I mean, we're seeing it like for our business, for example, before you got paid nothing to hold cash. So you had to make that decision. Do you want to take an investment risk where you could lose capital on that allocation, or hold it and get paid nothing, but at least, hold the capital? And now, like, we're able to, everyone now, you're able to pick up 4.5%, maybe, like on a overnight cash product, which is great. So which is providing a lot of stimulus, Steve. You're right, into the economy. The other thing that's happening now as well, guys, we'll use the US as an example. They're doing quantitative tightening, of course, but the Treasury General account, I think it is at the Fed, that's being drained by the Treasury right now. So that's offsetting the tightening that the Fed is doing. So even though the Fed are raising rates and they're doing QT, it is being offset by other factors at the Treasury, and that's being driven by the debt ceiling conversations that are taking place. But the point is, there's a lot of things happening on a daily basis here that's not getting a lot of attention, except for the Loonie Hour, where you can hear about that and other things like zooming around in the sky. We should call ourselves the Serious Hour. Who's going to tune into that?
No, that's true. That's a fair point. I mean, one more thing I think that's we haven't talked enough about is the bank. Not only is the Treasury providing liquidity and sort of offsetting a lot of what's going on with the quantitative tightening, but so are just plain old banks. Bank lending just continues to tick along. It's off its highs year on year, but banks are strong. They're in the US, sorry, be very, very clear. In the US, and bank lending continues to tick along. But back one last thing, Keith, on your savings point, Steve, on your savings point, which I think is really, really interesting. I just wanted to harken back to when I mentioned this several weeks ago, when I said that the amount of savings, it's not the savings rate that matters. That's a flow. What matters is the stock of savings, and the stock of savings is at the highest it's been relative to unsecured or short-term debt since 1971. And so not only do people have way more savings in their bank account relative to basically the last 50 or 60 years or whatever, but you're also getting paid 5% to hold those. And so that's another thing that's going to offset some of this negativity we may see. And also just, again, points to even higher rates for longer. I think that's sort of the moral of the story, I think, from my perspective anyway.
Yeah, and just to add to that too, I don't know if you guys follow Professor Richard Werner. So he was the author of Princes of the Yen. There's actually a YouTube video. It's about an hour long. So you can go on YouTube, Princes of the Yen. But he was basically the economist that coined the original term of QE, quantitative easing. And he's written lots of papers about, how money is created, how banks create money and lend it into the economy. So really, really smart guy in that aspect. And he's been arguing on Twitter and in a bunch of interviews and stuff that, raising interest rates to fight inflation it's not really the main mechanism that is going to squash inflation. He argues it's credit creation. Interest rates follow the rate of growth in the economy, and growth is created by new credit creation. And so he argues that, you have to get bank lending down in order to really squash growth and thus inflation. So, it continues to be the debate, right? I think that's the funny thing about, markets and the financial economy is it's a very complicated, interconnected system that nobody really knows the answer to. We're all just here trying to piece it together.
I have something to share with you on the savings rate or the stock in terms a couple of things. What I think that's severely distorted by people with a lot of savings.
Totally agree.
I think a lot of households are literally living paycheck to paycheck. A lot of households don't have like $1,000 available in case something happened to them. The other, actually, I have a piece here from one of our research providers, Ned Davis Research. I can share it with you guys. They show the aggregate household savings for Canada, the Eurozone, the US, and the UK. So it's back to the year 2000. And the stock went up to almost 2 trillion back during the pandemic. And now it's right back down to 700 billion again. So I think when you see more current data coming out, this is across 4 major Western economies, not just one, you're going to see that story has sort of played itself out as well.
I disagree, but that's okay. Keep going.
Yeah. It's but again, that's the comment on that. I know that's been used a lot, saying, hey, you know what, there's a ton of cash out on the sidelines and stuff like that. I don't think it's as clear cut with that narrative. I really don't.
I think, is that not just you could chalk this up to the continuing widening of the wealth gap, which is like the wealthier, that's if you're in the top 30, 40%, you're doing pretty well. And if you're in the bottom 50, it's just this gap. And it's interesting, like, Bloomberg just had an article out, was it today or yesterday, about, how new cars are becoming a luxury item, that, the total volume of car sales is actually down, but their profits are up because they're building more expensive, higher end cars, and people are, the wealthier that have the money are willing to pay for them. And it's been a good business model for these automakers. And so, you can make the same argument for housing. It's become it hasn't become shelter. It's become an asset class for the wealthy. And yeah,
but it might not matter. I know it sounds really horrible, but maybe we're opening up a can of worms at the end of our show, and maybe we can get into some other time. But it may not matter that there's inequality has grown. Some of the countries with the highest amount of inequality actually have very high productivity growth rates. Some countries, like Canada, that has not necessarily a high Gini coefficient, which is the measure by which you assess income inequality, have really terrible productivity growth. And what matters ultimately is productivity growth. The other thing is, what also matters is aggregate demand. And if you have a bunch of really rich people generating enormous amounts of returns and spending and are employed and whatever it is, it can and often does offset a bunch of very poor people not necessarily spending. So it's not necessarily clear that that's, it's just, I think it's too simplistic to say, well, there's a distributional impact from that we need to, that's like overwhelming the positives from those savings and the income that they generate. But again, that's like a huge topic. So
I just worry about my buddy Keith there getting a pitchfork in his back. So
why would I get a pitchfork in my back?
Because you in a mansion,
the wealthy and the social frictions that are building, they might come into your mansion and Throw a pitchfork through your window.
Maybe.
You want more taxes from me too.
But this conversation is very interesting. We'll talk about it some more. But I like over the years, I've met a bunch of guys with accumulated a lot of wealth, and they'll say to you, like, it's only so much you can spend. I mean, that's it. There's only so many steak dinners you can have. How many cars do you need or do you want, and stuff like that. I do know that the wealth gap, it's enormous. But you remember, wealth measures assets, not income. And I think that income gap, it's pretty severe. So I think that we are on this sort of precipice, or this edge, where if the economy does roll over, I think it is going to be quite stressful for a lot of households, especially those that bought properties in the last year or 18 months. And that's the risk that we have coming up.
Can I just say one more thing? I mean, that's why some people like me rail against negative real interest rates, because what that does basically is, as Keith alluded to, it shifts money from labor to capital, and it has done for 10 years. And that's why, again, people like me just are desperate for real interest rates to rise back above zero, stay there solidly, so that there isn't misallocations of capital into unproductive real estate assets, so that people actually have to make tougher, better investment decisions with their hard-earned money, and they don't just play the leverage game, which is what you do when you have massively negative real interest rates. It's bad for.
Are you saying real estate can be unproductive? Like, Steve is on the call here.
Get this guy off the show.
Shut it down, man. That's enough.
Shut it down. This is gone too far.
Down.
So I think that it is a good place to wrap it up. We won't get into the ability of governments to pay back their massive debt loads in the face of real interest rates. That's a conversation for another time. But as always, we appreciate the support of the Loonie Hour here. We continue to build the Loonie Hour community. All we ask is that you give us a little 5-star review on Spotify, Apple Podcasts. Share this episode with at least one friend or family member, and we'll see you next week.